Washington Mutual was founded in Seattle, Washington in 1889 as Washington National Building Loan and Investment Association. The commencement of its humble and caring beginnings started with the goal of rebuilding Seattle after a devastating fire. It gained its footing caring for others and was renamed and further nicknamed WAMU.
Hi, how can I help you?
So how many free checks do I get?
Well, it's free checks for life, so as many as you need for the rest of your life.
Cool.
You also get free ATM cash withdrawals.
Oh, let's roll.
WAMU free checking. We don't nickel and dime you. Woohoo! WAMU.
Washington Mutual started gaining consumer confidence with its clever marketing campaign, This Way to a Woohoo moment, and was proud of its self-given title as the bank for everyday people because it centered its business services on the average consumer as well as small and medium-sized businesses. Its pioneering banking ideas included children's penny savings account, telephone banking services, and ATM machines. With these innovative developments, it's not a surprise that by the 1990s, Washington Mutual had expanded nationally. By 2007, Washington Mutual was the largest savings and loan bank in the U.S. based on assets of $328 billion and revenue of $25.5 billion.
What are you up to?
Paying some bills online.
Oh, that's real safe.
I do all our banking online. WAMU's got this online banking guarantee thing, so I feel really secure.
Really secure. Wow, I feel really safe.
Yeah. Phil.
Huh? What?
WAMU online banking. We've got your back. Woohoo! WAMU.
With interest rates on the rise, WAMU's mortgage division was feeling the pinch. By 2004, it had closed 100 home loan centers and laid off more than 13,000 employees. WAMU's shareholders were not impressed and wanted to see profits rising. Its CEO, Kerry Killinger, decided that the lagging revenues would be rescued by adjustable rate mortgages, or ARMs. WAMU had traditionally carried the majority of its loans as fixed-rate mortgages. Fixed-rate mortgages require down payments and have constant monthly payments that are calculated to include interest and principal amounts over the life of the loan. Typically, fixed-rate mortgages are 30-year loans, although there are options for shorter time periods. The problem for WAMU, especially because its mortgage sector was struggling, is that fixed-rate mortgages do carry risk for the lender and can reduce banks' interest income. When interest rates rise, borrowers don't refinance to a higher interest rate, of course, but the market value of the bank's fixed-rate loans fall because now they are making less money on the lower interest rate loan. WAMU's mortgage division was struggling because of this, and action was quickly taken. In 2004, Option Arms was said to be the saving grace for WAMU's lagging mortgage division. With Option Arms, the interest rates adjust throughout the life of the loan, leaving the bank to have less interest rate risk because when interest rates rise, so does the interest on the loan. Thus, borrowers have a higher risk of interest associated with ARMs. Option Arms were attractive to WAMU because it provided an immediate boost to its lagging mortgage revenue. With interest rates on the rise, consumers look for low rates, which is notorious for Option Arms. Enticing low introductory rates, coupled with options for borrowers to pay low monthly payments, Option Arms became mainstream. With different options, borrowers could choose to pay the full interest and principal amount, or pay just the interest, or even less than the interest payments. By paying less than the interest on the loan, the unpaid interest increases the principal amount of the loan, leaving the borrower to owe more than the original amount of the loan. While the borrowers are paying each month, they could actually be buried in a rising loan amount with option arms. But the bank is making huge revenues off the interest and fees associated with it. Coupled with a low understanding of option arms, it could lead to a shock when the introductory rate ends and the principal amount of the loan has increased as well as the interest. With all of these financial benefits, though, WAMU relied heavily on option arms to boost its revenue.
Fixed versus adjustable rate mortgages. Mortgages aren't one size fits all, and to get the one that's best for you, it's important to understand what makes them all different. To keep this simple, we're just going to focus on two different kinds of mortgages: a fixed rate mortgage and an adjustable rate mortgage. While there are a lot of different kinds of mortgages within those categories, figuring out which of these two types best suits your needs is a good place to start. A fixed rate mortgage is exactly what it sounds like. It's a mortgage that keeps the same rate for the entire life of the loan, typically 15 or 30-year terms. So let's say you take out a 30-year fixed rate mortgage with a $2,000 monthly payment this year. You'll still be making that same payment of principal and interest 10, 20, and 30 years down the line. Then there are adjustable rate mortgages, also known as ARMs. These mortgages have interest rates that can change depending on market conditions, meaning that your monthly payment can go up or down. The most popular type of ARM taken out today is a fixed period ARM, also known as a hybrid ARM. They're based on a 30-year term and typically start with an initial fixed interest rate for a specific period of time, usually 5, 7, or 10 years. For example, a 5-year ARM will be referred to as a 5-1 ARM, and its interest rate will stay the same for the first 5 years. Because the interest stays the same for 5 years, the monthly payment of principal and interest will also stay the same for this time period. But after that 5th year, the interest rate is subject to change annually for the remaining 25 years left on the mortgage. The rate will change based upon changes in the current financial market, and that means that your monthly payments will change based on the interest rate applicable at the time of adjustment. So make sure that you're prepared to make higher monthly payments if interest rates rise. So which of these loan types is best for your situation? Asking yourself some key questions can help you figure it out. 1. Do you want the predictability of knowing what your principal and interest payments will be year after year? 2. Are you planning to stay in your home for a long period of time? And 3. Do you want protection from rising interest rates in the future? If you answered yes to any of these questions, a fixed-rate mortgage may offer you the stability and predictability you need, especially if this home is where you plan on raising your family or retiring. And now, a few questions to help see if an ARM offers what you need. 1. Is this a starter home, or one that you aren't planning to stay in for a long period of time? 2. Do you believe that interest rates might go down in the future? And 3. Will you be able to afford your payments when the fixed rate period is over and the rate resets and possibly goes up? Now, if you answered yes to any of those questions, then an ARM might give you the biggest bang for your buck in the short term. That's because many times the interest rate during the fixed period of the loan will be lower than what you'd typically get with a fixed rate loan. So when it comes to buying a home, whether now or in the future, it's important to know the ins and outs of getting the right mortgage. What's more, you need to have your financial house in order before you get started, so work out a budget. Look up current interest rates. Run some numbers using an online mortgage calculator. And be sure to be honest with yourself about how much home you can really afford. Because you're not only setting out the welcome mat for a happy home, you're making a financial commitment for many years to come.
While there are standards and regulations to be approved for a loan, including one's credit score, WAMU began fraudulently doctoring borrowers' loan applications using one client's credit information and proxy of the applicant in order for the client to get approved. In 2005, there was an internal investigation in two of WAMU's most profitable branches in California. It was discovered that 83% of the loans coming out of the offices were fraudulent, meaning they lacked proper documentation or false information about the borrower's income and ability to repay the loan. In another branch in Westlake, California, employees would manufacture documents for prospect borrowers by cutting and pasting documents from current clients. This was done to speed up the approval process. The employees were paid by the number of loans they generated, not the quality of the loans originated. So management endorsed the bad loans and in some cases trained employees how to doctor them. No action was taken by the bank management to correct or end these practices. The problem was so bad, in June of 2007, AIG refused to insure the mortgages coming out of one of the branches. This fraud was significant because it wasn't just the mortgage applications that were hurt. WAMU was taking these mortgages and repackaging them as securities and selling them to investors. So even investors were being deceived. AIG waited 3 months expecting a reply from Washington Mutual, and when it hadn't received one 3 months later, notified the state and federal regulators about WAMU's fraud, according to CNBC's Mary Thompson. This is the relative proportion of option arms and fixed rate loans that WAMU had in 2004, 5, 6, and 7. As illustrated in the chart, WAMU's proportion of the risky option arms far outnumbered the proportion of fixed rate loans. In 2006, the highest difference in spread was 22 option arms to 1 fixed rate loan. This led to the inevitable demise of WAMU. Its portfolio was too risky and could not withstand a volatile economy. Here we can see WAMU's peak fraudulent activity and why it became the largest saving and loan bank in the U.S., although it had achieved that prestige based on fraudulent numbers, including assets of $328 billion and revenue of $25.5 billion. Time to put on the brakes.
But I can't forget the words my baby said. She said, "What goes up, I know one day it's got to come down."
So what goes up must inevitably come down, especially when it's based on fraudulent numbers. By December 2007, the national average home value was down almost 10%. The last time housing prices had fallen this much was during the Great Depression. Nationally, there was 10 months worth of housing inventory on the market. In California, there was 15 months worth of unsold inventory. Normally, the state had 6 months worth of inventory. By the end of 2007, many loans were more than 100% of the home's value. WAMU had made too many subprime mortgages to too many unqualified buyers. In August 2007, the secondary market for mortgage-backed securities collapsed. Like many other banks, WAMU could not resell these mortgages. Falling home prices meant the principal amount of the loans were more than the houses were worth. The bank could not raise cash. In the fourth quarter of 2007, WAMU wrote down $1.6 billion in defaulted mortgages. Bank regulation forced it to set aside cash to provide for future losses. As a result, WAMU reported a $2 billion net loss for the quarter. Its net loss for the year was $67 billion. On September 15, 2008, Lehman Brothers filed bankruptcy. WAMU depositors panicked upon hearing this. They withdrew $16.7 billion out of their checking and savings account over the next 10 days. It was 9% of WAMU's deposits. The Federal Deposit Insurance Corporation said that the bank had insufficient funds to conduct day-to-day business, and the government started looking for buyers because the U.S. Treasury and the Federal Reserve would not bail it out like it had Bear Stearns and American International Group, according to Kimberly Amadeo. How do the AICPA rules of professional conduct apply to WAMU? Let's begin with integrity. Integrity is measured in terms of what is right and just. In the absence of specific rules, standards, or guidance, or in the face of conflicting opinions, a member should test decisions and deeds by asking, am I doing what a person of integrity would do? Have I retained my integrity? Was anyone with WAMU asking those questions? Objectivity and independence principle states a member should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities. For a member in public practice, the maintenance of objectivity and independence requires a continuing assessment of client relationships and public responsibility. Due care requires a member to plan and supervise adequately any professional activity for which he or she is responsible. Members should be diligent in discharging responsibilities to clients, employers, and the public. Diligence imposes the responsibility to render services promptly and carefully, to be thorough, and to observe applicable technical and ethical standards. The scope and nature of services states that each of these principles should be considered by members in determining whether or not to provide specific services in individual circumstances. Obviously, there were many AICPA standards that were lacking regarding WAMU. Though management is responsible for the internal operations of the bank, the accountants should have been raising red flags all along the way. This was brought up in a class action lawsuit stating that the accountants and the auditors of WAMU were defendants because of their lack of professional conduct. The lead plaintiff in the class action lawsuit against Washington Mutual and those charged with governance was the Ontario Teachers Pension Plan Board. It was the largest single profession pension plan in Canada. Ontario teachers invest the pension plan's assets and administers the pensions of approximately 278,000 active and retired teachers in Ontario. As of December 31, 2007, Ontario teachers held more than $105 billion in assets. Ontario teachers purchased over 5 million shares of Washington Mutual common stock on the New York Stock Exchange during the class period and claimed to have suffered damages as a result of the defendants' violations. While the class action lawsuit named the auditors and accountants as defendants, management was obviously named as well. WAMU was poorly managed and its managers were fraudulently running the day-to-day operations, making outrageous statements, lying to its investors, and filing false paperwork. While the accountants and auditors were not involved in the day-to-day operations, they should have known what was going on if they were taking due care. This would have been easily done, at least by 2005, when the internal investigation discovered that there were multiple branches that were filing 83% fraudulent applications. The question of who is at fault is not one or the other, but both. Management, as well as the auditors, violated the AICPA code. Because they have the responsibility to the public, neither one kept a high level of professionalism required by the code.
As the debate in Washington rages on about how to bail out the nation's economic crisis, another one of the country's largest banks has collapsed. Washington Mutual has gone under, seized by the Federal Deposit Insurance Corporation on Thursday. The FDIC then turned around and sold WAMU's thrift banking assets to JPMorgan Chase for nearly $2 billion.
I'm not going to say that that is not going to happen, but no matter what, WAMU has a really impressive severance package, and I think that's going to be carried on even if there is a merger.
Washington Mutual's fall has been widely anticipated. The bank's stock has plummeted 95% of the past year. On Thursday, it closed at only $169 a share. Like many other financial institutions, WAMU fell victim to heavy mortgage-related losses, including the once booming subprime mortgage business. For WAMU employees, nervousness abounds.
Of course, we're going to have some uncertainties and some questioning about what's going on. Have I been nervous? Sure. I mean, it's just kind of the nature of the whole beast. When a large company gets bought out, you wonder about your job. Our head's going to roll. You just don't know. But we have faith in our bosses and the people upstairs.
Washington Mutual was founded nearly 120 years ago and is by far the largest bank to fail in the country's history. WAMU is J.P. Morgan Chase's second acquisition this year. In March, J.P. Morgan bought the investment bank Bear Stearns. J.P. Morgan Chase is now the second largest bank in the country, only standing behind Bank of America. J.P. Morgan Chase says the acquisition will give it 5,400 branches in 23 states. It plans to close less than 10% of those. Orla Reese, Associated Press.
References included.